As of this very moment, on this active trading Friday, November 28, 2025, Bitfarms stock, trading under the ticker BITF on the NASDAQ, is hovering right at $3.23 USD. We are seeing a distinct upward push in intraday action, with the stock climbing over 4.5% since the opening bell, driven by significant pre-market volume that saw shares changing hands as high as $3.31. While the broader tech indices are showing mixed signals today, Bitfarms is decoupling from the standard crypto-only movement that usually dictates its price action. If you are watching the order book right now, you will notice a flurry of buy orders stacking up at the $3.20 support level, fighting back against the profit-taking we typically see on a Friday. This is not just random noise. This is a market pricing in a fundamental shift in what this company actually is. Most investors look at that $3.23 price tag and see a Bitcoin miner. They see a company whose fortune is entirely tethered to the spot price of BTC, rising and falling with the volatile waves of the cryptocurrency market. That is the expectation. It is the safe, comfortable narrative that has defined this stock for the last 5 years. But the reality, the deep, structural reality that is only just beginning to surface in the institutional filings and strategic updates, is that Bitfarms is rapidly extinguishing its identity as a pure-play miner. What you are actually looking at today is a discounted entry into high-performance computing and artificial intelligence infrastructure. The market is slowly waking up to the fact that Bitfarms is sitting on one of the most valuable assets in the AI economy: massive, secured, immediate power capacity. While retail investors are arguing about Bitcoin price targets, smart money is realizing that this company is converting megawatts into AI data centers, a transition that historically re-rates stocks from a low commodities multiple to a high-growth tech multiple. To understand why this $3.23 level might be a deceptive floor, we have to look at the immediate catalyst driving today's sentiment. The market is digesting the implications of the company's aggressive move to convert its Washington state facility to support AI workloads. This isn't just a press release promise. We are talking about a site specifically being retrofitted for NVIDIA GB300 GPUs, the heavy artillery of the AI world. The expectation was that Bitfarms would keep plugging in ASICs to mine Bitcoin until the margins compressed to zero. The reality is that they are actively pivoting to a GPU-as-a-service model in their most power-efficient locations. By retrofitting this 18-megawatt facility with advanced liquid cooling, they are effectively arbitraging the difference between the volatile revenue of Bitcoin mining and the stable high-margin revenue of AI compute hosting. This is the same playbook that sent stocks like Core Scientific soaring earlier this year, and the market is now placing its bets that Bitfarms is next in line for that valuation uplift. When you analyze the intraday volume we are seeing today, it is important to contextualize it against the broader sector. You have heavyweights like Tesla stock and NVIDIA stock dominating the headlines with their own AI narratives, but the infrastructure layer, the companies that actually provide the electricity and cooling for these massive computations, is where the supply bottleneck truly exists. Bitfarms has secured power. In 2025, power is the new gold. The reason we are seeing this stock push past $3.20 today, despite a generally quiet post-holiday trading environment, is because institutional desks are running the numbers on the revenue per megawatt for AI versus Bitcoin. The spread is undeniable. AI compute can generate significantly higher revenue per unit of energy than mining, especially in a post-halving world where mining difficulty is at all-time highs. This brings us to the elephant in the room regarding the stock's recent volatility: the hostile engagement with Riot platforms. For months, Riot has been aggressively accumulating a stake in Bitfarms, now holding over 14% of the company. This isn't a friendly investment, it is a battle for control. Riot knows exactly what Bitfarms is worth, and their hostile takeover attempts earlier this year were a clear signal that they viewed BITF shares as significantly undervalued relative to their physical assets. While Bitfarms rebuffed the $2.30 takeover offer as too low, the fact that a competitor was willing to pay a premium to swallow them whole validates the asset base. Today's price of $3.23 puts the stock well above that initial offer, proving the board right, but it also keeps the tension high. Every dip in Bitfarms' stock price is viewed by the market as a potential buying opportunity for Riot, creating a unique soft floor under the stock. Investors are effectively betting on two winning scenarios. Either Bitfarms succeeds in its AI pivot and re-rates to $5 or $6 on its own merit, or Riot returns with a sweeter offer to consolidate the sector. Let's step back and look at the company's operational footprint, because this is where the expectation versus reality gap is widest. The general assumption is that Bitcoin miners are capital-intensive money pits that burn cash to generate coins. While that can be true, Bitfarms has executed a strategic masterstroke by selling off its Iguazu, Paraguay facility to HIV Digital Technologies earlier this year. They essentially sold off a dedicated mining asset to recycle that capital, approx $85 million, back into their U.S. expansion. This was a decisive move to de-risk their portfolio from geopolitical uncertainty and focus on the lucrative, deregulated PJM energy markets in the United States. By moving their center of gravity to the U.S., specifically Pennsylvania, they have made themselves more attractive to U.S.-based hyperscalers looking for AI partnerships. You simply can't sign a contract with a Microsoft or an Amazon for AI hosting if your data center is in a jurisdiction they deem risky. Bitfarms has cleaned up their map, and the market is rewarding that clarity today. We also need to discuss the recent Stronghold digital mining acquisition, which closed earlier in 2025. This deal was not just about adding exahash, it was about acquiring power interconnection rights. Stronghold brought valuable assets in Pennsylvania that are directly connected to the grid, bypassing the years-long waiting lists that plague new data center developers. In the world of online investing, it is easy to get lost in PE ratios and moving averages. But in the world of physical infrastructure, the only thing that matters is time to power. Bitfarms bought time. They bought immediate access to energy that would take a greenfield developer 5 years to permit and build. This acquisition is the hidden engine behind their 2026 growth targets, and it is a detail that many retail investors using platforms like the Robinhood app or SoFi Invest might overlook when simply glancing at the earnings per share. Speaking of earnings, let's tackle the financials, because this is where the bears usually make their stand. The expectation for Q3 2025 was a disaster, widening losses and struggling margins. The reality was nuanced. Yes, the company reported a net loss of around $46 million, largely driven by non-cash depreciation and impairment charges. But the top-line revenue grew to $69 million, up a staggering 156% year-over-year. This is the tension I mentioned earlier, the accounting loss versus the cash flow growth. If you only look at the net income line, you miss the story. The company is generating significant cash from its operations, which it is immediately plowing back into upgrading its fleet and building out that high-value AI infrastructure. The loss is the cost of rapid transformation. We are also seeing a massive improvement in efficiency. Their fleet efficiency has hit targets of roughly 19 joules per terahash, making them one of the most efficient operators in the space. In a game where electricity is the main expense, efficiency is the only moat that matters. Now, I want you to pause for a second and think about your own portfolio. Comment below how many shares of Bitfarms you currently hold, or if you are waiting for a pullback to enter. It is always fascinating to see where the community sentiment is. Are you holding for the mining cycle, or are you buying the AI pivot story? Let me know in the comments. Continuing with the analysis, we have to look at the macro environment for Bitcoin itself, as it still dictates a portion of Bitfarms' revenue. We are well past the 2024 halving, and the miner capitulation that many predicted has largely played out. The weak hands have folded. Companies with high debt and inefficient machines have gone bankrupt or been acquired.
Bitfarms, with its strong balance sheet, bolstered by the Uruguay sale and strategic financing, is one of the survivors. The network hash rate is at an all-time high, which usually hurts margins. But because Bitfarms has aggressively upgraded its fleet to the latest T21 and S21 miners, they have managed to maintain their production levels while competitors are falling off. This is a game of last man standing, and Bitfarms is standing tall. But the real juice, the real reason to be watching this stock today, is the optionality. When you buy Apple stock, you know what you're getting: iPhones and services. When you buy Bitfarms at $3.23, you are buying a call option on two distinct futures. Future A is a Bitcoin supercycle where BTC hits $150,000 and Bitfarms mining margins explode. Future B is the AI infrastructure play